Hello and welcome to this week's instalment of Nucleus Investment Insights. This week our focus turns to the rising risk of global and local inflation. Inflation is a phenomenon central banks have long desired and tried to engineer. If prices are rising, then presumably so are incomes. Sustained inflation also erodes large household debt burdens. But there are always risks that an unexpected spike could catch investors off guard and lead to sharp declines in the value of investments that have benefited from low rates. Over the last week, there's been a sharp rise in yields as existing bonds were sold off, forcing investors in all asset classes to sit up and take notice. For now, at least, inflationary risk is the most important and talked about issue in financial markets. Locally, the 0.9% headline inflation rate for the October-December quarter was higher than market forecasts of 0.7%. Largely because of higher costs of pandemic-related childcare, alcohol and domestic holidays and accommodation. Whether this continues in post-COVID Australia remains the question. So, will record low interest rates, pandemic-level monetary and fiscal stimulus, along with surging asset prices, translate into long-term inflationary pressures? And what are the cyclical versus structural components? Here to share his thoughts on whether the emerging inflation risk is real or just a mirage, I'm joined by Nucleus Wealth's Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Tim.
And also joining us on the line, we have our Chief Strategist, David Llewellyn Smith. Hello to you, David.
Hello, Tim.
Good to have you on. And just a quick reminder that before we get started, if you haven't already, subscribe and click the notification bell to be notified of when we go live or have a new webinar to watch, or follow us on your preferred podcast platform. We also ask if you'd like to take a moment to click like on the video now to help our show grow. And for those listening in live, feel free to drop in your questions in the YouTube live stream chat to have them answered along the way. So we'll jump into our agenda for today. We're going to kick off with some inflation factors. We're going to then roll around to some thoughts on deflation factors. We'll then answer the question of the day, I guess, how to invest in inflation, and then roll out, as we always do, with our investment outlook and how these themes impact the portfolios here at Nucleus Wealth. So with no further ado, we'll kick off with our inflation factors. Returning to trend, Damien.
Yeah. So I'll grab this one. What I wanted to show, and I've got two charts on there. One on the left is just showing an economy, a low inflation economy, one that's running at 1.5% inflation. And what I'm sort of showing here is if that was the trend line where inflation was just going to be below the RBA's band quite considerably, but that was the trend we're on, and effectively that's the trend we've been on for a number of years. But then we had a 1 year dropping back into deflation, and then returning to trend after that. What would happen is that 1 year where you're returning to trend, you're going to get 4.5% inflation. And so it's going to look like you've got this high inflation economy, but you're really just returning back to your old sort of low inflation trend. And that's what we think. That's our base case for how we're expecting this to play out. Is that we've had deflation for a year, and then we're just going to return back to trend, but it's still going to be but you're going to get this one-off sort of kicker. And whether it's in 1 year or whether it's spread out over 2 years is probably a little bit more likely. But it's all those things where people sort of cut their prices or whatever to try and keep the volumes up for that year of COVID, and then just return their prices back to where they were, or with a little bit of inflation worked in. And so so that's the biggest factor on inflation is that, and that's what we're so we're certainly expecting prints of 3% plus. So I think what we've been saying, as a broad sense, is there's a lot of people out there who have been promising inflation for years and years and years, and saying that all this central bank money is going to lead to hyperinflation, and the governments won't be able to keep it under control, and yields going to skyrocket, and all these sort of dire threats. All those people are going to get their day in the sun, because over the next 6 to 12 months, it's going to look like we're in an economy with lots of inflation, and for them, we're going to see on newspapers and financial media and blogs and all that type of stuff, all those people saying, "Hey, look, I was right. I was finally right. All that government spending, came home to roost, and look out. Now we're going, this inflation's entrenched and it's going to be there forever." And so,
Weimar Republic.
That's right. Or Zimbabwe. Take your pick. Yeah. So that's so each of these trends. That's of the inflation factors. We'll run through each of them because there's a whole bunch of other ones that we've got. But the thing you will note is most of them are like this in that there is a one-off effect and then it fade. But we've got a lot of one-off effects all hitting at the same time. So So maybe we go to the next. Sure. The next one. I might pass this across to you, Dave. So commodity prices.
Yeah, well, at the moment we're clearly in what is a typical post-recession commodity reflation cycle. It's got a couple of different dimensions to it. One is as you see the global recovery rebound, you almost always see a weak US dollar, and that tends to inflate, have a financial impact on commodity prices as the dollar falls and they're priced in dollars, so the commodities go up. We've also had a year of reasonably robust Chinese stimulus to keep bulk commodities in good shape. Oil has been absolutely brutalized, obviously, through COVID, and that's shut down all sorts of stuff on the supply side, from OPEC keeping 8 million barrels a day offline to US shalers dropping output by about 2 million barrels a day. And now we have some rebounding energy as well, energy demand. And that'll continue through the year with travel returning. And we have some other things going on, excuse me, like we had an inventory cycle globally, which has kept goods production very high, which again, is creating lots of demand for commodity inputs. And more recently, over the last month or two, we've had this huge spruik suddenly emerge from Wall Street, telling everybody that inflation is coming, that this is a new commodity super cycle, in inverted commas. And so there's then on the back of all those previous trends, you get a big financial flow of people into commodities who are looking to hedge inflation via holding hard assets.
Yeah, and that's important because a number of indexes are reporting just massive volumes of people buying them, and so obviously if you're seeing the copper price, for example, spike up because there's a whole bunch of people out there using copper, then that's a good thing for the commodity over the longer term. Good thing for the commodity price over the longer term. If you're seeing, though, the price spike up because there's a whole bunch of speculators who are all jumping in trying to front run demand they're expecting to come, that's obviously a worse scenario because the prices will be higher, so not as much demand will come, even if the demand was ever going to come at the level they're expecting. And at some stage, those financial speculators are going to get out. They're not going to sit there and hold these commodities that actually cost some money to hold on to. They're not going to hold them for years and years and years. At some stage, they've got to get out. Whereas the person who's actually buying it to use it, that's obviously a lot more of a solid case.
At the moment we've got what you might describe as a virtuous cycle going in commodities. To me, it just looks like a regular post-recession reflation and recovery. But you do have this virtuous cycle in which rising commodity prices drive inflation, which drives financial flows into commodities.
Yeah, that's right.
Which is also could be characterised as something of a Ponzi scheme. And I don't think it will last because, we'll come back to that later. But for the time being, if you look at this chart, you will see that the broader commodity indexes have basically doubled over the year. And so that gives you immense inflationary impacts in terms of base effects from year to year. So This is very inflationary right now.
Yeah, and I've got two other ones for this. One is the back on the commodities still. One is that the commodities are there's been a shift towards goods rather than services. So as economies have locked down, and hairdressers and manicures and things like that, people haven't been able to do that. There's been more spending on
real goods.
On real goods, yeah. Just because that's all people can do. So that's led to a greater commodity demand than what you might see otherwise. And
yes.
People, whether it's doing up their houses or buying new laptops or things like that, you can expect that there will be a fade off in terms of that. And the other factor is, especially for copper, which is sort of often driven as one of these ones, there's been this whole there's been this real sort of push into EV electric vehicles, and led by Tesla as this is going to be it's now X the last couple of days, but it made Elon Musk the richest person in the world for a little bit, and Tesla was worth more than every other car manufacturer on the planet put together. You've seen that same go right throughout the electric vehicle space, whether it be lithium or whatever, and copper's been one of those beneficiaries of that. So it's like this, all of a sudden, copper in a way has been like a tech play. It's like not only a technology stocks going up, but stocks related to them have been as well. And so that's where, and that we think is an unsustainable. It's unsustainable in terms of it, because basically, although electric vehicles do use way more copper than a traditional vehicle, about 5 times as much. The problem is there's actually not that many electric vehicles being put out at the moment, and even if you and vehicles just aren't a big source of aren't a big user of copper anyway. It's sort of 10 to 12% of global copper is actually used in vehicles, and so when you sort of do the maths, there's only a few percent per year extra copper needed in order to, even if you had an extremely bullish view on the rollout of electric vehicles, you just do not need that much copper relative to the total size of the copper market every year.
Mm-hmm. All right, very good.
So that's commodities. I'll let you go with this one too, Dave.
We'll jump across to supply
disruptions.
That one, that sort of segues into this, I guess, where you're discussing this shift last year from services spending to goods in all the developed economies, and that's more or less been something of a supply shock for global freight. And so on this next page, we've got incredibly high freight rates right around the world, because these containers are whizzing around the world at a furious pace, trying to deliver all of these extra goods, combined, of course, with some COVID disruptions to shipping. Excuse me. And then there's a second chart here as well, which is showing that industrial production and manufacturing around the world is struggling to keep pace with this demand at the moment, and so they've also got blowing out delivery times at the same time. They've got high demand and they can't deliver the goods quick enough, and they've got cost input inflation from commodities, and so all of these things combining are again very inflationary short term.
And there's the car industry is one that sort of hit the headlines in a lot of places recently, because basically they cancelled a lot of their orders for semiconductors last year because they thought demand was going to be terrible, and then demand bounced back really quickly, and they've gone to make all their orders, but the factories are already full building laptops and all these other things, and so they just can't get they can't get the chips, and also to sort of do the runs they're expecting. It's not just like a turn the light switch on. It's like no, you have to set up your production run for it, and so it's the great example of you've got this car that you've put together. You've got your BMW that's cost you thousands of dollars to put together, but you're missing, say, the chip to push your seat backwards and forwards on your electric positioning of your seat, and that's it. You can't sell your car.
Yeah, that's right.
You've sort of, you've got this whole big car, every other part, but you're missing that one part because you didn't order it, and now they're backlogged and they can't get enough out. So that's affecting. I mean, the cars one's definitely the worst. Well, sorry, not definitely the worst, but the highest profile are the worst ones. But there are a number of other cases where that's happening as well.
Just on that, so the top right chart there, we can see longer delivery times for the US, UK and the Eurozone, and yet Japan seems to have sort of steadied out. Is there any thought on why Japan doesn't seem to have been
probably because it's an exporter, I would guess. Like
they've thought ahead,
I suppose I'm assuming that a lot of their output would go domestically, but that's not necessarily the case either. They're a big exporter, so.
Yeah, I'm not sure.
And they're also a huge commodity importer. So I don't have an explanation for that.
Yeah, and I guess, and the other thing is they haven't been nowhere near as hard hit by coronavirus as US or Europe, but yeah, they're not. I'm not sure.
Yes.
Smaller market, I guess, as well.
Yeah, I'm guessing it's a mixture of those ones, but it's probably worth having a bit more of a closer look.
Yeah. All right.
Yeah.
Very good. All done on supply disruption, fellas?
Yep.
Jump across to our inflation factors. Cyclical, first off the rank.
So we've split them into two different types. One is the cyclical, which is the shorter term factors that are sort of more one-off. And then the second part is the structural changes, which are sort of ongoing changes. So the first one is changes in consumption following COVID. I guess what I'm talking about here is everyone's been put through these changes in terms of how you're going to do things. Maybe you're eating out more. Sorry, you're getting more deliveries than what you used to. You're not shopping as much in person. You might have changed to maybe not go to the gym as much and buy more gym equipment at home, or just other factors that have all changed in terms of how people are doing things and just the different allocation of how they're spending their time. Mm-hmm. And what that tends to mean is that there are companies out there that are suffering from lack of demand, and there's other ones that have got too much demand just because people have changed their preferences as to how they do things.
Or it's more available.
Yeah, and that tends to you get this friction in the economy, which tends to create a bit of inflation when you have it, just as the people who are now more attractive or now getting more demand start putting their prices up, and they're getting lots more people using them, and the people who are dropping their prices or firing people, and it just takes a little bit of time to sort of rebalance the economy and hire away. But so it's a relatively short-term effect, but it does happen, and it could there could be a year or 2 years play in terms of just seeing that inflationary factor come through, and other ones as well in terms of let's say it's the demand for exercise bikes. And so, because the demand shot up, the people who are selling exercise bikes are more than happy to sell them at, say, $100 a pop. But because there's so much demand, they've upped the price to $150 so that they can, ration the ones that they have. And at the same time, they're increasing their production as much as possible because they want to sell as many as they can at 150. Mm-hmm. And then you'll see over the next couple of years, that 150 will end up back at 100 because the reality is, at $100, they're willing to produce as many of these as possible, and maybe even if they're producing more, maybe the price is only now they can sell it at $90 because they're actually they've doubled their production runs, and so their unit costs are a bit lower. But there's a short term 150, and then that's going to come back down to where it was, and that's why we're calling it a cyclical change in inflation, and we're very much expecting to continue to see that. So we've seen it already, and we're expecting that to keep going.
Okay.
So, and we. Excuse me, we'd expect basically as economies reopen that big spike in goods demand will reorient steadily back towards services. This is what people last year were describing as the K-shaped recovery, where you have all the stuff that benefits from stay at home is in the upper arm of the K, and all the economic activity relevant to going out is in the bottom arm of the K, and those two basically, as as conditions normalise, mobility normalises, the vaccines take effect, the two arms should converge. And so, as Damo says, what are inflated prices now will actually then hit demand that's returning to trend, if you like.
And expanded
There's
supply.
a lot of that spending. Yes, and expanded supply. And so a lot of the gap between those two arms of the K will just converge.
The next one then, inventory cycle rebuild. So I think David already touched a little bit on this, but basically the idea is that if when you're rebuilding the inventory cycle, the simple version is if you're selling couches and you've got 10 couches on your floor and you get in 10 every month. And then all of a sudden there's this demand shock, and you only have 5 couches in. You only sell 5 couches. So that month you actually you only order another 5 couches. Sorry, you still get your order of 10 couches in there. And now I've got 15 couches on my floor because I didn't sell as much as I think. Now I can actually go a month without any, and so I go to zero sort of ordering from my manufacturer. So he's really suffered. Then demand goes. And I'm said, okay, cut it back to 5 per month after that. So that sort of sets me up. I'm back to my 10 on my store, and I'm only selling 5 per month. Now, when I go back to buying to actually selling 10, what happens is I actually sell my entire inventory, and so I go. Now I actually need. Not only do I need another 10 couches, but I also need an extra 10 to fill for next month.
Yep.
So I've actually gone to double the amount, and so there's this inventory cycle where.
Plus, you might actually sell 15 because you've got pent-up demand coming back in.
Yeah, and so you get this supercharged effect in terms of your inventory cycle, and very much the retailers. He's gone from selling 10 to selling 5 and then back to selling 15 or whatever. So it's been quite volatile. But the guy on the other end, the manufacturer, has gone really volatile because they might have gone to 0 for a few months production, and then they might have ramped up to 20 or 30, to fill this gap. And so before sort of fading back to the 10 again. And so, that inventory cycle rebuild can be a significant effect on economies.
Yeah, it's very typical of a recession and post-recession recovery. The inventory cycle actually plays a critical role in first hitting GDP, industrial output and GDP, and then supercharging it out of that dip.
Then you got the government stimulus, and I guess what I'm talking about here in terms of cyclical side is
it cyclical anymore? Government stimulus?
Yeah, that's right. Structure change. Yeah, but I guess what I'm thinking is in terms of employment. If you've got government giving people money who aren't doing anything and they're out there spending that money, then effectively you've got you still got 100% of your economy people in there out spending money, but you've only got 90% of them working. And then so that means there's more demand for the goods that are out there, and sort of starts to push up prices. And then as the people start to work again, that sort of comes off. So there's some of that is in terms of government stimulus, and we're certainly seeing there's another round in the US coming. Most European countries still have a fair support for in terms of stimulus. So it's the next one. And then the final cyclical factor, and then I'll let Dave do the structural ones, is a lower, and this is for the US in particular, not for other countries, but the lower US dollar. So the higher your currency, the cheaper it is for your people to buy, for your citizens to buy imports.
Yep. You get more widgets with the same amount.
Yeah. So a higher currency equals lower inflation, and a low currency equals higher inflation.
Yep.
And the US dollar has been going down quite significantly. And so within the US, you're going to see a bit of inflation just from that lower US dollar.
Well, it does create inflation worldwide, though, too, which is it's all part of the whole commodity cycle that we discussed earlier. The lower US dollar sends up commodity prices, which really helps lift the entire emerging market complex. It sends capital outwards from the US into all of the higher risk jurisdictions, so it inflates a lot of asset prices and stuff as well. This is all part and parcel with a typical cycle. So the lower US dollar is very reflationary, for the world, and it is particularly inflationary for the US. But that only lasts so long, and if we get further into the discussion on the US dollar, this cycle is a bit atypical in that it's basically on amphetamines. It's been super, super quick from the beginning. We had a super quick crash as the virus came in. We had a super quick crash up as the stimulus came in. We had a super quick inventory cycle and rebuild. Even as the virus went through second and third waves, that transpired. And we've had this US dollar go down really fast and this super quick commodity super cycle, again in inverted commas. Like, this is normally like years and years in the making, and it's all transpired within 12 months. And so I'm skeptical now that the US dollar can keep falling for a number of reasons, but the principal one is that as this accelerated cycle moves forward, the US economy is shaping for this absolute super boom over the next 18 months, possibly 2 years, because it's got everything firing at once. All of its rebound and recovery dynamics that we've already discussed, huge fiscal stimulus, much bigger than anywhere else, especially Europe. We all know about incredibly low and generous monetary policy that's suppressing yields in everything, including, really high risk assets, meaning debt's freely available to corporates. Its stock market's going nuts. Its housing market's going nuts. Its consumer has had just an absolute helicopter drop of cash. Something like 2 trillion in excess savings that can be run down. And so, this is just a glowing kind of, some people are worried about overheating US boom that's coming. Its vaccine rollout is much better than Europe. And so typically the US dollar falls because Europe, is going to bounce out of the recession really well too. But it looks like the US is just going to completely outperform Europe this time around. And so I'm getting quite skeptical that the US dollar actually can fall much further, because its yields are rising and should keep rising faster than anywhere else. And its growth outperformance will make it quite tough for the US dollar to keep falling. So again, it's very much a cyclical part of inflation, and then the moment the US dollar stops falling, you get the reverse of everything we just discussed.
Unwind.
Which is US inflation. Well, US inflation starts to get capped, commodity prices come off, emerging markets start to lose capital. The whole thing it suddenly just gets a big handbrake pulled on it. So this is why we see the US dollar as a cyclical component as the current inflation pulse. I mean, it's an ongoing debate about how much lower it can get, but it's definitely a cyclical factor.
Okay.
Right, very good. And structural.
Yeah, well, just before we do that, I'll just a quick note to those listening in. Feel free to drop in any questions in the chat box as well, in the YouTube live chat box. But yeah, let's jump across to the structural factors.
I'll leave you to run through these, Dave.
Onshoring in strategic goods, David.
Sure. Well, obviously the pandemic has underlined to various governments around the world that their supply chains are vulnerable to shocks that they never really considered, in various strategic goods. So that could be anything from, medical supplies, through to semiconductors, all sorts of different things. And so we're going to see some onshoring of those supply chains over the next few years as governments seek to shore up the risk, especially given the virus is likely to be an ongoing issue, in whether managed or to whatever degree it's managed. It's unlikely to entirely just disappear. And so that means, some of those things are going to be more expensive to produce because they were globalized because of global supply chains and obviously specialization, etc. All of those capitalist factors that meant that these things could be produced more cheaply elsewhere and be shipped in, but you can't rely on those things always when there's a world that's got pandemics. So that will be, inflationary at the margin in some things, and that will be permanent because you're actually shifting the cost base higher.
Yeah,
Sorry, go on.
With the disclaimer as well that there'll be other ones where the onshoring is going to be largely automated. So you're sort of moving from, say, quite a manual process in China or sort of a developing country to quite an automated process, say, in the US, which might be inflationary initially, but once you've got it, chances are that that's going down in cost over time. So technological costs tend to reduce every year, and so quite possibly, while you might see a bit of inflation coming through from that sort of over the next 4 or 5 years, because that's not like a we've decided to onshore a lot of our, say, semiconductor, which is one the US is targeting. Let's do it, and then next month they've got a factory up and running and they're pumping them out. That's sort of a 4 or 5 year. Build factories, get them up to speed, start transferring and all that type of stuff. Like that's not a quick change. But once you're through that period, quite possibly there's a bigger deflationary push, 4 or 5 years down the track from that.
Yeah, sure. Now, related to that, I guess I'd just jump down to number 4 because it fits. China's deglobalization. I mean, we're going to see ongoing supply chains coming out of China for obvious reasons, with the Cold War frictions going nowhere. They'll persist. There's a structural change, so that will be marginally inflationary, although, again, a great deal of those, and probably the vast bulk of them, those supply chains will reorient to other emerging markets. For US imports, they'll likely shift to jurisdictions that are much more clearly within the US kind of security umbrella, if you like. Mexico perhaps. Yeah, Mexico or Southeast Asia. And so that's not necessarily particularly inflationary, but it's part of the onshoring kind of trend, and maybe a little bit at the margin as well.
Yep. And one of the ones actually it sort of fits sort of into this, probably more structural, more cyclical, that we didn't really talk about in terms of inventories, but it's the filling out of, there was this whole just-in-time view on terms of you get your parts made and you get them delivered just before you need them, and very much in the car industry. And that's had a serious rethink now about saying, okay, well, maybe we actually should be carrying a few months worth of parts and supplies, so that if something does happen, we're not in this position of your $2 chip preventing your $50,000 car from being sold.
Yep.
That's a one-off though.
Yes.
So that'd be a cyclical one. Yep. And then we come to the sort of flip side of fading government stimulus that we had as cyclical, and that is modern monetary theory and the fight against inequality. We do expect fiscal support will be higher than it was in the previous low-inflationary cycle, and we're seeing this play out most clearly in the US, although it's even managed to permeate the halls of austerity in Brussels, but nowhere near to the same degree. So we've got a $1.9 trillion package at the moment in the US that may probably get watered down a little, but it's certainly going to come through pretty strongly. And then following that, they'll move immediately probably to $1 trillion worth of infrastructure stimulus. And all of these things are designed very much to fight inequality, to get low-end wages rising, and to fight Trumpism, basically. I mean, I think this is principally the Democratic strategy to keep Trump out of power in 2 years and 4 years, and if they succeed in doing that, he's pretty much a dead duck, because I think he'd be too old beyond that. So we can certainly expect ongoing support, more than we did in the secular stagnation cycle, as it was called, over the last 10 years. However, it's also clear that MMT is far from embedded in policy circles. There's still a lot of skepticism from all sorts of quarters, whether that be old school monetarists, or people who don't like government spending, who are maybe big on small business and small on government deficits, whatever it happens to be, there's still plenty of resistance to it. And for instance, there are no real universal basic incomes coming forth, and there's progress on this front, but it does not look like it's the new black yet, to me. As we go into the cycle, and my conclusion ultimately in this discussion will be that after a year or two of inflation, we expect a return of lowflationary dynamics. Then at that point, we'll probably get a better test of how embedded this MMT business is, because we'll be forced to go for another round of pretty decent stimulus if it's going to persist and make a structural change to inequality. So it is a structural change, but I just don't think it is deep enough yet to rely upon for ongoing inflationary dynamics. That said, embedded in this $1.9 trillion stimulus at the moment are US minimum wage rises, which we think are terrific. There's a big brouhaha at the moment over between the two parties in the US about how they'll actually settle. The Dems are looking at trying to more or less double it, I think from $7.50 to $15 over about 5 years. Kind of those numbers may not be precise, but they're roughly right, and sort of $1 a year or $1.50 a year. The Republicans countered with, I think, $10 over 5 years, and so there's still plenty of distance between the two.
And I think as well, though, it's worth noting that there are a lot of states that already have minimum wages that are a lot higher than the $7.50 or $7.85.
Yeah, there are, but they're a lot below it.
Yes.
Well.
Yeah, and the other thing is the studies that are out there are basically saying a 10% rise in the minimum wage they think causes about 0.25% of inflation over the next 2 years. So sort of right. So I think it's sort of 0.18 in the first year and point something in the second year. So while it feels like it would be very inflationary, the actual effects are not particularly inflationary.
Interesting. They're not, and you do get offsets as well. Like you do get some job losses that come out of minimum wage increases, but they're actually quite minor, and they're more than offset by the increasing standard of living for those that get the wage hike, and that increases demand, obviously, which produces more jobs. So you see a little bit of diminishing of jobs, but it's really quite small in reference to most studies. So it's well worth doing, and politically is essential, basically, for the health of capitalism. So hopefully the Dems will get something pretty good up and running on that front. Can it turn into wage push inflation? Look, I suppose it could. It would certainly, if they get a decent one up and running, then that is certainly going to sustain the US inflation impulse a little more than elsewhere at the margin. But then you come back to what I was discussing earlier, where you've already got the US with a growth and yield advantage. If it's got an inflation advantage as well, then you're going to see a rising US dollar, and so you'll see as a result, other deflationary results of it. In terms of worldwide inflation.
Yeah, and keep in mind what I was saying. That if you've got a 10% rise every year, say for the next 7 years, 8 years, in terms of the minimum wage to get you to those numbers, and that just means an extra 0.25% of inflation, effectively. It's not a huge. We're so far below in recent years we've been so far below that extra 0.25 is not like it would have pushed you over the edge of anything.
No, that's right. So again,
it's just the minimum wage,
it is higher inflation at the margin, but we don't see it as creating a wage push cycle.
And sorry, actually, I should just define what David means by a wage push cycle is what we saw in the 70s and sort of early 80s, where wages would go up by 4 or 5% per annum or more because inflation, that's what inflation was. Or actually, yeah, it's probably 7 or 8% per annum because inflation was 5 or 6%.
Yep.
And then that would mean that inflation went up again, so that then wages would need to go up again, and the spiral just kept on going, where you needed to sort of break the link between them. Once you sort of broke that link, then you went in the opposite direction. But,
yeah. And the other structural force, of course, is the ongoing virus disruption. So everything that we've seen on the supply side, etc., and described in this prezzo so far, could end up happening all over again if we get some mutations that manage to dodge the vaccine. I should rather say when we do, and how they're going to be managed is obviously going to determine the vector for inflation through those disruptions. But you could potentially see repeats of the kind of supply side crunches that we've had here and there if the virus gets out, new viruses get out. So I guess the upshot of all that is, in terms of the strength of inflationary pulse at the moment, we're definitely building into a pretty decent spike over the next 6 to 12 months, especially the next 6 months, because we'll have all of the base effects from last year's crash in inflation. If you're referring back to Damo's original chart on page 1, where we see the catch-up spike. And so that's going to be pretty decent and is going to freak a few people out. But the structural drivers of inflation are still not persuasive enough to see that turning into cyclically sustainable.
And it's important to note, central banks have said that they're going to ignore this inflation. They've already said, this, we need to see sustained. We know there's a spike coming and all that type of stuff. And that's true, but it's obviously going to be different when it's much easier to say that when you've got deflation or 0% inflation, saying no, we're going to look through this spike. When we are printing 3 or 4% inflation things for 1 or 2 periods, there'll obviously be more pressure on them to saying, well, what, if inflation stays where it is or goes higher, will you? And then central banks will probably say, well, yes, if inflation, we're expecting to keep it on hold because it's temporary, but yes, if this stays where it is or goes higher, we will be raising rates. That's where we expect markets will take those statements as being rate rises are coming, up goes. Whereas the more likely scenario is what we're coming to. This is the deflation side.
Yes. So we're going to have a short-term inflation spike. We don't think it turns into sustained inflation, and in fact, we see quite big deflationary forces. So, which I guess this discussion is really about how long the spike lasts before these deflationary forces come to bear again.
Yeah.
And
I guess it is worth noting, though, before we get off the inflation, is it's completely possible that we could have that this inflation could morph into something bigger, but it's going to need to be a lot. There's going to be a lot more. There's going to need to be a lot more stimulus than what we're seeing at the moment.
Yes,
in our view.
Do you want to do wages there, Damo?
Jump across to deflation. We've got a terrific chart up here from the Reserve Bank. One of my favourites. It shows that
terrific, so long as you don't work there.
Yeah, well, at least in this area, these guys couldn't forecast a pie in a bakery. But
having said that, and it's worth giving them some credit for actually showing it, though, in terms of their I think it's a great. At least it's starting to get them along. It got them along the lines of going, maybe we're doing something wrong. Which is a good realization to have. The first step is to admit you have a problem, and then you can start solving it. Whereas for a long time there, what would happen is there was this forecast that wage inflation was going back to 4%, and then wages would fall, and then they'd say, oh no, next year it's going to go to 4%. And then the wages would fall again, and they gradually sort of ease themselves down to maybe it's 3.5%, and maybe it's 3%, and every year it was just keep on forecasting this snapback in wages that just never came. And that's what we're coming back to is is it likely that that things have changed to snap us out of this low wage growth when we've actually got much higher unemployment than what we had beforehand and some big bits of structural change. And For us, we can't see anything that's fundamentally changed, and if anything, it looks like the factors that were driving wages down are going to be there for even longer. So getting that wage growth back up again is going to be difficult with high unemployment, let alone not making the structural changes that were sort of causing that to happen in the first place.
I mean, there is one interesting component to this in Australia's case is the cessation of mass immigration will certainly provide relief to the permanent labour market supply shock that we put ourselves into, which was a fancy way of saying that there are just a lot more people competing for jobs coming from offshore, many of whom coming out of developed markets were happy to work in worse conditions and for lower wages on temporary visas, etc. And all of that, or an awful lot of that, was killed by the virus. And so, we've faced an interesting question if we manage to get through a year or two of rebounding growth, where unemployment is starting to come down persuasively, whether that might generate some wage price inflation more quickly than the previous cycle. But that's offset, of course, by the more open we are and the more that becomes a possibility, the more likely the current federal government will be to immediately reopen the borders and re-inject temporary workers into the economy. So those two probably cancel each other out.
Yeah, when you say the current federal government, I think it's the same if the opposition was in power. They're still looking for more people as well, aren't they?
Look, it's actually better on the other side these days. They've become much more sceptical about temporary visas, even to the point now where the new Roscano book, which is out this week, Reset, demands a big cut in temporary work visas.
And big shout out.
He was previously.
We'll have Ross on. We'll have Ross on the 18th to talk about that as well. So he's coming on in 3 weeks.
We will, among other things. And so there is a pivot in the Labor Party away from a sort of one-eyed view of all mass immigration being good, and that will affect wages. It doesn't help the other pressures that come from population growth, because temporary workers leave, of course, and if you sustain high immigration, permanent migration, then you'll have the other pressures that brings: house prices, choked infrastructure, etc. But it will aid wages. So if we get a change of government, then it's possible that Australia will see better wages growth. That said, I couldn't see it tearing away, but it may not look like this disastrous chart.
Just a quick question on that one as well. So, let's say, for example, as you say, tightened labour, higher wages. You'd feel it could turn into inflation if people want to convert that into spending power. But what about things like deleveraging, paying down our enormous?
I don't understand the question.
No.
What's this deleveraging you talk about?
We are actually doing quite a lot of deleveraging. But it's being, it's not being swamped. We're paying down debts as other people take them out, basically.
Yeah.
So there's a lot of rotation in the banks.
Yeah, but you're right in terms of it. It's the high savings rate at the moment, which is preventing that spending.
Robbing inflationary push.
You need that demand to come through.
Yep.
Yeah.
Yes,
if you're not getting the demand, then people are not spending their money because they're saving it to pay off loans. Then that flows through the rest of the economy.
Yep.
And
so for the time being, at least, we think that the wages position will be pretty deflationary. So that brings us to deflation factor number 2, and this one's the big one for me in a global sense. Basically, we think that China is already hitting the brakes on its COVID stimulus, and so it's the best measure of that is its broad credit, total social financing, which these days has local government bonds included in it, which so it therefore incorporates a lot of infrastructure as well as household loans and therefore the property market, and they're really the big two when it comes to the bulk commodity drivers. And it's now been falling for 3 months, and there's been a number of different kind of prudential tightening measures put in as well on developers and on housing loans that started in January. So I expect that trend to basically increase as we go forward into the year, principally because I think I don't think we've got the chart. No, I didn't put it in actually. But if we looked at a chart of Chinese exports, they've gone absolutely nuts over the last year. Like for a year or two before that, Chinese manufacturers were really in the doldrums through the trade war with the US. But the pandemic was just massive for them because we had this, as we've discussed, this huge swing towards goods demand in developed economies, and Chinese production of those goods just went nuts.
And also China had a much better virus experience, so places that were shut down.
Things.
Yeah, so not only did we want more stuff, manufacturing was shut down in a lot of countries, but still open in China.
Yep.
Yeah, and so that's going to persist through this year as the developed economies reopen, first the US and then later Europe. And so it's going to have a very robust export sector this year. And so it can basically, growth stabilisation has been achieved, and it can now, return to what has been its long-term goal, which is economic restructuring and trying to get away from this supply-side debt addiction that it's had, which is, basically overbuilding apartments and roads and bridges to nowhere. So I already see them getting back to that, and I think it'll intensify as the year goes on. And then, so that brings you to the conclusion that despite a lot of the rhetoric around this commodities super cycle that we're going to see, it's going to confront a Chinese brick wall within 6 months of falling demand, specifically for iron ore and coke and coal, but more broadly than that too. I would expect things to start to just simply slow in China. So, for instance, this year it'll probably do 8% GDP. I think next year it'll be well under 6, probably near a 5. And it's very big, so I'm not talking about demand falling off a cliff, but I am talking about it diminishing. So, that's going to hit a lot of commodities demand, just as we're supposedly ramping up new supply with these skyrocketing prices. And so this is why we see, one of the key reasons why we see the commodity recovery as a cyclical phenomenon, not a structural one. Because if you don't have a permanent new source of demand, as we did from kind of 2000-ish as China entered the global economy, which then creates the need for a whole caboodle of new supply permanently, then what you've got is just a cyclical recovery that will diminish over time, and so commodity prices should come off, and that will be, if that happens, more or less commodity prices start to come off 6, 8, 9 months after China starts tightening credit. And so this means you should have pretty significant falls going into 2022, starting through the second half of this year, but especially 2022. And then you get the absolute reverse of what we've got this year with the base effects. So you come into 2022 with really high prices last year, and then rapidly diminishing ones this year, and so suddenly your inflation pulse turns deflationary. I think that applies to oil as well, which is obviously the big one in terms of developing economies as well. Goldman and Wall Street is out there celebrating a new super cycle for oil. I think that's bullshit too. Partly that story will be about China, but partly as well, that's again a cyclical recovery and demand meeting. 10 million barrels of oil per day being off the market, and that will simply start to pour back in and compete for market share as the price rises. So I see the same thing happening for oil. Damo, you want to go for expectations?
Yeah, so I've got two charts here. One's the first one's the Australian inflation expectations, which is a consumer-based one, and you can just see there that the expectations for the last sort of 5-10 years has been substantially lower than what it was the previous 5 or 10 years. So people tend to think of inflation, but when you ask consumers how much inflation they're expecting, they tend to very much overstate the inflation they're expecting versus actual inflation. But what's clear is that the levels of inflation that are expected at the moment is significantly below what they were before. And what that means is when people are going for pay rises and even just their own, they're running businesses and they're working out how much they think they can increase goods. If everyone's expecting 5% inflation, then they'll want to be putting their wages up by 5%, or they'll want to be increasing prices by 5% if they're running businesses. When you're expecting 2% or 3% inflation, is obviously much lower, and so there's certainly no signs that inflation expectations are in any way elevated relative to where they've been, relative to where they were 20 years ago when we last saw inflation particularly high. And then if you jump to another type of one, now I'm using the US numbers here. This is the implied inflation. It's the 5-year. It's basically if you look at market pricing 5 years in the future and then work out how much inflation is expected for the next 5 years after that period. So it's quite a long-term look at long-term pricing of inflation. And you can see again, this is the US numbers. There's certainly no, it's the same thing. The last 5-10 years has been significantly lower than what it was the previous sort of 20 years. And there's no signs that you've reverted back to your sort of early 2000s, or 1990s, higher inflation. So I guess what we're saying there is that there's a certain amount of deflation is within expectations. If people are expecting inflation, they'll price it in, and central banks have done a good job of such a good job of convincing people that inflation will be kept a lid on, that that those expectations haven't been getting away, and they're certainly not to say that they never will, but at the moment they're pretty firmly anchored in their sort of the range of the last few years.
Yep.
And then we go to other deflationary factors. So a whole bunch of ones here. We could have put charts up on this, but we'd already put up a lot of charts. So the technology. Look, we had a long chat with
Booth.
With
Booth.
Yeah, with Michael Booth.
No.
Sorry. Anyway, we had him on Jeff Booth.
Jeff Booth.
Sorry, we had him on a show probably 6 months ago, just talking about that whole technological deflation. He's got a lot of good charts and a lot of things that just showing that the more you're reliant on technology and the more processes are automated, which we are finding more and more, those costs tend to come down year after year after year, and that sort of embeds deflation into your economy, and the technological changes are accelerating. And so that sort of means that we've got this overhang that you need to overcome of technological deflation that's out there. Commodity speculation, Dave, put that one back to you, and Zombie.
Yeah, well, I mean, I guess as China slows, and this is related to US outperformance as well, I think as China slows and US outperformance comes to bear through the second half of the year, and therefore the US dollar stops falling and even starts rising, the entire thesis of a commodity super cycle evaporates, and so everybody pouring into commodities to hedge inflation driven by commodities just reverses.
Yes,
it's the end of the financial flows into commodities.
Yeah, and all that. I was talking about it before. All these traders jumping in to buy copper before copper price goes up or whatever. And then eventually they sit there and start going, well, okay, the copper price has either gone up or it's stopped rising, and so now I've got to start selling because otherwise I'm just sitting on this thing for no reason, and they that drives prices back down.
Or in the case of iron ore, you just get more supply comes back, because there's a whole lot of brownfield stuff that they can reopen, which is another difference between now and a genuine super cycle. Is there's a lot of idle supply all over the place in everything. And then suddenly, in fundamental terms, you've got enough. The price starts falling, and then the speculators get caught on the wrong side of the boat, and they all pile out.
Yeah. Zombie hangover.
So this one's really big. If you look at kind of high yield debt in the US or emerging markets, there's zero stress. Right now, this is quite a phenomenon, given we've just been through the worst economic shock in many decades. This is because the Fed is sitting on these markets and other central banks, and this is where QE becomes a self-defeating phenomenon, because by controlling the yield and risk in everything, it means that that risk is never priced in debt, and so the weak players in any given market never go out of business, and this actually derails one of the key drivers of constructive capitalism, which is creative destruction. And that cycle is supposed to drive out, the crappy and weak players over the stress of a recession and the misallocated capital, etc., so that the efficient and good players are then in a position, to sell more, to bring prices down, to increase their margins, etc., etc. And so you get better productivity, better income for everybody. They invest more, and so the whole of society kind of moves forward.
And the people from the zombie firms go and work in a different industry
in a virtual cycle. But what you get now with all of this artificially suppressed risk is nobody goes out of business. So ultimately, you end up with too much supply. And right now, when we've got all of these extraordinary tailwinds coming out of the shock and the new cycle and the stimulus, etc., none of this matters. But fast forward 18 months, 2 years, when these things start to fade, the fact that we clean none of this stuff out over this cycle will start to become a very dominant factor for the unfolding cycle, and you will have too much supply again in everything. And everybody's struggling to get any kind of purchasing power, and so you end up back in a secular stagnation and lowflation environment.
And that's sort of a little bit dovetails into the flat supply curve. But what I meant by that next one was more about there is a lot of goods out there that are available to be sold. In terms of China, if you want to buy cheap plastic toys, and the world all of a sudden wants, or the world over a few years wants double the cheap plastic toys that they had from 5 years ago, China can produce it and leverage up its factories and pump it out at the same price as what you used to get it. They don't need to. It's not like you all of a sudden need to double the price of all these cheap plastic toys because they don't have enough plastic or they don't have enough molds or people to do it. There's really just this timing issue in terms of the globalization and the outsourcing of manufacturing around the world, and now the outsourcing because of work from home. Now you can start outsourcing, your IT jobs or your more of these ones. If I've got somebody working from home, they may as well be working from home in India or the Philippines or somewhere else where people can actually get lower priced employees, which sort of puts a cap on how much you can raise prices. Because you've got what we call this flat supply curve. You want to add more production, more capacity, and there's just an almost infinite amount of capacity available there because the whole world is linked and
currently available.
Yeah, okay. Yeah, and then we've got our old two bugbears of high levels of debt and inequality. First one, obviously, saps spending power over time, and inequality. Is a case where if you start to concentrate too much of your wealth and income in the hands of too few people, then the demand levels in your economy simply fall away, and again that's deflationary because you've got too much supply. So that's some pretty serious structural challenges to inflation.
Yeah. And sorry, the last one's meant to be US dollar outperformance as well as your other.
Oh, right.
Once you I kind of covered that one with commodity speculation, but yes, I mean that's deflationary globally in the sense that capital comes out of everywhere else into the US, and really hits commodity prices.
So how do you invest then? That's
just one last one. Just quickly on the deflation piece. Energy price deflation.
Yes.
Is that way into it? You've got the Green New Deal coming out. You've got the ability to create solar for nothing versus high cost coal.
It's not as much of an issue in US or China as what it is in Australia. Because Australia energy prices are so high, and Europe to a certain extent as well has got high energy prices. They just don't have quite as good solar resources there. Is what we'll see is Australia's sort of the front of this in terms of we've seen certainly over the last year just more and more solar plus batteries and do we put on, we need more supply, we need more peaking power or whatever, do we put another gas-fired power plant on or do we just build some more batteries and more the batteries, and that's coming down in cost. So it's, to me, to us that's a lid.
I know that Australian electricity prices at least are no longer high. All of that new supply has killed the price over the last 12 months.
Yeah, you tell my energy provider
it's got that lid. It's put the lid on that prices, so that's now just coming down over time. So we think, absent some short-term spikes, Australian electricity prices have pretty much peaked, and will just come gradually down over the next sort of 15, 20 years. The thing
gas
is that
price is different. That's still a big fat cartel gouge. But at least the electricity market has been largely decoupled from the gas supply shock.
Yeah. Now the US already has much cheaper energy than what Australia does, about half the cost. Right. So they will get there, but not yet. And so I guess the issue for and China's similar in terms of, and partly because a lot of it's subsidised in China, but you're going to see that energy prices in Europe over the next few years will peak. Possibly, they might have already peaked, but if they peaked over the next sort of 3 or 4 years, I wouldn't be surprised. And then they're sort of up against this technological curve. Australia is pretty much up against the technological curve already. The US probably won't be there for 5 to 10 years. Because they've got such cheap gas there, and cheap coal as well in the middle of the US, and some nuclear power and other bits and pieces. So they will get there, but not yet.
Okay, all right, very good. Thanks for that. How to invest? Sorry,
so this is the important part.
Where do we put the money?
So we're pretty certain about this, but we're not absolutely certain about the timing of the inflation. So it is an issue about saying, and we are pretty certain that there's going to be an inflationary shock where people are going to be pricing in inflation. And over the last few days, even we've just seen this. It's gone a bit exponential over the last few days. So quite possibly this is we might be talking at a local high, if you know what I mean, and then we might see bond yields come back down again before going again.
I think we go further, but.
Yeah, I think over the next 6 months. I guess what I'm saying, over the next couple of days or the next couple of weeks, we might be at a local high because it's certainly gone parabolic over the last week or two. But we are expecting those bond yields to keep rising. There will be then an opportunity to buy back in and at the longer end and take advantage of those longer term bond yields falling. So within our portfolios, everything's all in the very short term stuff. That's all
protected by the RBA.
Sorry, but not all, but mostly. We're mostly huddled in the sort of 2-year bonds and protected by the RBA, as David said. And then there will be a time to buy those longer ones. It is a question of when, and really now it's about how much markets start pricing in. And there's only a certain amount they can price in before we're going to start seeing central banks stepping in and starting the yield to curve control anyway.
Well, and that's a question. Obviously, they've started. Well, Australia last year sort of doing that landmark decision to actually kick off for the first time ever open market operations at the short end, and then it seems to be increasing.
They're spending in the long term, but they've it's been ineffectual at the long end. So because that's driven by global forces, and the RBA hasn't managed to keep the long end of the bond out, despite targeting it.
I think they'll march out there before long.
Yeah. Well, it'll be interesting to see. But I guess what we're saying is in the bonds, there'll be an opportunity, but it's not yet. And so and it's, we still have that little bit of uncertainty that maybe you do start seeing more MMT type policies come out, or Llewellyn's got a much bigger expansion plan from helping debt states or local governments to borrow more or whatever that we can't see yet, that will actually cause inflation to actually take hold and to get a proper cycle going. But I think at the moment
they got like a 5 trillion new Green Deal going or something. It'd be it could be a game changer.
But it might be, and when you say when David's saying 5 trillion, it might not be headlined as 5 trillion. It might be 5 trillion, but it's more likely to be 5 trillion behind the scenes that you don't see, because local governments are out there borrowing 1.5 trillion, and states are out borrowing another 2 trillion, and then the feds are chipping in 1.5 trillion. So it might look like 1.5 trillion, but when you add up all the little bits below it, it actually ends up being a lot bigger. So we can't discount that happening, which is why it's not time now to say, okay, I'll take a loss. I'm happy to take a loss if bond yields keep on going and jump into the long end at the moment. I think it's well worth being more cautious and just waiting on the bonds.
Yep.
That sort of means it's a similar story then for your value versus growth. Means you need more value, less growth in your portfolio, but you're going to get these opportunities to buy growth stocks over the next few months or year or two at a much cheaper price. Because if we do return to deflation, those growth stocks are once again going to be in demand. So it is a matter of having the growth stocks you like, but there's ones out there that are priced at incredible multiples at the moment and have been falling recently. We're expecting that to keep going for a few months, and so price, you need to be quite picky about what price you're buying in at, and not just always with growth is the key. It's never about not never about sorry. It is important to get the story right, but it's just as important to get the price right. So we'll go back to the Cisco example that I keep trotting out. The last 20 years they've increased their earnings 6 times, and their share price has halved because the price was so high to start in the tech boom. So it's a matter of getting that price right. And then, so the moment it's for us, it's on the value trade, and then we want to flick back into that growth later on in the year. There are some exceptions. The Aussie dollar, though, again, the same story. Aussie dollar's got the momentum behind it. We've got more, a decent bit more Australian stocks in our portfolio than what we do international stocks. But you're going to get you're getting chances to buy international stocks at cheaper prices over the next 6 to 12 months. If you can buy these with an Aussie dollar of 80 or 85 cents, here's your chance to start getting exposure to international assets that are going to be very beneficial over the longer term at a discount, because the Aussie dollar is so high.
Yep. Okay. Very good.
Dave, did you have any?
No, that's about right. I flop around day to day between thinking the Aussie's going to stop in the low 80s or go to the mid 80s. I still don't think it'll get much higher than mid, but that's quite right. At the moment, we're long Aussie or overweight Aussie because we think that continues for a while, and when it reaches sort of unsustainable levels, we'll be looking to pick up those assets.
Yeah. And in terms of exceptions, there are some exceptions within sectors, and it's worth noting that there's ones where we're reluctant holders, I guess. So we've got a lot more banks than what we feel like we'd like to have, but we've just got to recognise that in a rising long-term bond environment, it is good for bank profitability, and bank pricing will therefore be driven up, and that's one we're certainly looking to exit that a lot sooner, just given that we have more concerns over sort of asset quality and whether there could be issues in terms of asset quality, and also the thought that if we are in this deflation and yes, we're all headed towards the European and Japan experience, then the banks are really going to be the ones that suffer from those flat yield curves. But for the moment, there's a bit of a trade in there, and there are some other sectors. Commodities we've sort of been a little bit in and out of, but there's that same thought about there's a value trade in there, but it's not an infinite value trade, and we are concerned about the downside as well as the upside. So iron ore, for example, 2 or 3 months ago we held a bit of it, and even names that we sort of like Fortescue or something, quite higher risk ones that we traditionally wouldn't have owned. But we've sort of started tipping out of those because the iron ore price has got pretty close to as high as we think it's going to get, and the downside risk sort of is starting to weigh on the upside opportunity. And so we're happy not to try and squeeze every last drop out of that sort of value lemon, and but we think there's a bit of with exceptions, we think there's still room to go on that value trade.
Very good. We've got our. I think we've probably covered off a little bit on our investment outlook.
Yeah,
but, I think we'll leave it up there just as rate. Thanks very much, gentlemen, for a great show. Just mindful of time too. We have run over a little bit on this very full inflation look in. So thanks again for coming along, David.
Pleasure.
Excellent.
Great to be back.
It is, and thanks to you, Damien, as well for your thoughts. And we'll jump into our question of the week. So the question of the week is, are you worried about inflation? Feel free to drop in your thoughts in the YouTube box. We always enjoy reading your comments, and it gives us a little bit of guidance on what our listenership, I guess, is feeling as well. So feel free to drop those in there. Thanks again to all those who watched in live for another great episode, and I hope you've taken away some great ideas. And if you haven't already, feel free to click like on the video to give us some feedback. If you'd like to see more of our content, head over to nucleuswealth.com/content to stay up to date on news from us. Follow us on social media. And finally, if you know anyone who'd get something out of today's episode, let them know about it, share with a friend, and help our show grow. Thanks for tuning in from myself, Tim Fuller, and the team, and we look forward to catching you at the next one.